Thank you. So well behaved. So we now have a terrific panel for you of investors. We've had terrific speakers all day, and these gals and guys will not disappoint, particularly with their fearless leader, Bob Eccles. Professor Eccles is at the University of Oxford, formerly at Harvard, really one of the foremost thinkers around materiality in sustainability, looking at ESG investing, very active on the Sustainability Accounting Standards Board. I mean, really, anything that's important around this whole topic, Bob's been there, right? Really? Really? It's true. I saw you. So we're thrilled to have him introduce briefly and then host a great conversation with the investors. And I want to thank all of you for being here as well. Thank you.
What she meant to say, like the subtext is he's been around, all this stuff. What she meant was he's really old. That was the subtext, so I kind of picked that up. Before we jump into it, just to give me a sense of the audience, how many people are from corporates? Companies, how many people from companies? And investors? More companies and kind of the leftovers? Have you seen that TV show? Yes. It's great, The Leftovers. It's fabulous.
Students? Are students leftovers?
They're leftovers, yeah.
Oh, okay.
Yeah.
Starters.
Yeah, they're starters. This is school, they should all be students, right? We're at the Stern School. So let me explain what we're going to do here. I'm just going to tell you the names. We're going to go in order, and each member of the panel is going to take a couple minutes and tell you about what they're doing. I'll ask them some questions. They can ask each other questions. We'll kick this around for about 45 minutes, and then we're going to open it up to the audience for questions, and we'll end promptly at 2:15. There's a logic for the order of speakers. We're going to start with Herman Brill. He's at the top of the food chain. Okay, he's an asset owner. So he's with the UN Pension Fund. So, he's at the top of the food chain, and he's like a really good guy, right? UN Pension Fund and Sustainable Development Goals and taking care of beneficiaries. So, like, Herman's a really good guy. And he's Dutch. Okay, so that's good, too. And then we have Jonathan Bailey, who's with Neuberger Berman, and he's a pretty good guy.
I'm worried about how this is going to end.
Elizabeth already knows where this is going because we had coffee, right? So he's with Neuberger Berman, and they're an asset manager, and he'll tell you about what he does. And he's got an English accent, and it's just always sounds better, whatever he says, with a British accent. And he went to Oxford. And then we have I guess she's my friend, Elizabeth Seeger, depending on how this goes. She's not with TPG. So that's the good news. And she's head of sustainability at KKR. We met because I wrote a case on what they're doing, which I think is terrific. So it's interesting is we're going to have basically sort of the public markets, although Neuberger Berman does work in private equity, they're going to private equity view. And we've got Bo Lescott, who is a portfolio manager at a company really focused on kind of ESG and how that generates value over the long term. And then for good reason, my good friend Rena Kupferschmidt-Rojas is coming last because she has more money than all of these people put together, like times 10. Probably. So she's head of sustainable investing at UBS, and she oversees the investment bank, the asset management business, and your wealth management platform has how much now? 2.4 trillion. So if there's just a little bit of time to network with the panelists after she's the one. She's the one you want to talk to. She's the one to befriend. But Herman, tell us about what you're doing at the UN Pension Fund.
Well, thank you, Bob, for this kind introduction. I feel rather small now after these big numbers, but being a good guy, that shouldn't matter too much, I guess. But it's great to be here. Also, Tensi, thank you for inviting me. It's a pleasure to be here. So let me tell a few seconds about the UN Pension Fund. We are and it still exists, a defined benefit, open plan pension fund. Not only for the staff members of the United Nations, but also for about 23 different agencies across the world. So we have global liabilities and we have global assets. So we manage about $65 billion. I know it's just a drop in the C for you, but $65 billion globally across the world in multiple asset classes. And so another thing which is different, I guess, from many other public pension funds, we're not only the asset owner, but we're also the asset manager, because we manage about 85% internally, in-house, all in New York here. And it makes a difference also in terms of, if we talk a bit more about implementation later, there's a difference between an asset owner and an asset manager in terms of complexity and governance and decision making and what have you. So what we've been doing in what I call sustainable investing, I don't use the ESG and CSR and SRI, all those words. I don't think it's extremely helpful necessary. We talk about sustainable investing. We are long-term investors. We think it's really important to think about this concept within our fiduciary responsibility. We basically manage on behalf of all our participants, and for most people in the UN, biggest financial asset. So for us, everything we do should meet our fiduciary responsibility. And so all the investments we make, we look at sort of, okay, is this a risk-return profile in line with our expectations, in line with our policy benchmark? So I always tell people we're not impact investors, but we're investors with an impact. And I think that nuance, they have a different objective. They want to achieve impact or an outcome, basically. And we are institutional investors, and our outcome is, first of all, to make whole on all the promises we gave to our participants. So I think that's an important consideration as well. But having said that, we do believe that integrating ESG and all those type of factors into your investment process should help you over the cycle to improve your risk return compared to sort of the traditional way. It's an investment belief. It's something we are still working on. It's a journey. It's if you want to integrate ESG or become a sustainable investor, it's not about flipping a switch. This is really hard stuff, and I'm sure my panel members will agree with this. It's difficult. It's complicated. It has a hard component, which I call technology, data, providers, systems, what have you, and it has a soft component, which is culture, people. And actually, the soft component is harder than the hard component. It's always difficult to make sure and to create buy-in across the board in an organization to implement change. And so people initially would think about, oh, we need data providers and everything, but it has two components. And I think that's really important if you start thinking about implementing this stuff in your organization, that you manage both sides of the coin. A few words about what we do. We apply restrictions, screening. We don't invest in tobacco and armaments, but it's completely aligned with the mission of the United Nations for decades. That is nothing new. For me, that's not really per se sustainable investing or ESG. This is really value-based decision at the sort of the mission level of the organization. This is where we stand for. Then we have ESG integration. We are, again, on a journey to integrate ESG holistically throughout all asset classes, public equities, but also the private markets. And every different asset class requires a different approach. And the third component of our strategy is engagement. So one is screening, restrictions. Two is integration, holistically at the total fund level. And three is engagement. We are, teaming up with other pension funds in collective engagement, like the Ceres initiative, Climate 100 and Plus. We are signatory of that. We also work together with PRI, with other pension funds, to engage with companies. But we're also in the process of teaming up with a specific engagement provider, helping us to extend our capabilities, because we have a global footprint in our investments, but we have about 100 people in New York. I cannot engage with every single company on planet Earth. That's just too difficult. So we're going to work with an external provider to help us to increase our footprint. And I think it's also important to realize that building in the ESG integration in your investment decision process is one component. But if you really look at the research and the research we've done internally, it's I think the really the sort of the impact of the effectiveness of the strategy is the combination of integration and engagement. You need both components to work in sync to be effective. And again, this is something for, don't expect the next quarter to see all kinds of brilliant results. This is something which you do for the long term and which you will most likely see an improved outcome of your risk-return profile over the cycle, say over a 5-year period. So it's no silver bullet, it's not magic, it's also not very exotic. In the end of the day, this is really about mainstream investing, but you take into account all kinds of factors which were traditionally sort of outside of your scope. You just ignored, most portfolio managers and people in the investment world, they ignored that whole part, which sort of didn't exist for them. And sometimes there was a shock, where a company went through a crisis because of an externality, and that we call that bad luck, right? And I think that's sort of integrating the externalities, looking at the world more holistically, what's out there, and how it could potentially impact your risk-return profile, is, I think, the core of this whole philosophy. And so a lot of people, make it very exotic and, complicated, but if you really drill it down, the principles are pretty straightforward and actually pretty intuitive as well. But we use a lot of complex language and, and words and et cetera, which creates these labels. If people talk about, are you a responsible investor? Well, people say, well, what should I answer? If I'm not a responsible investor, I look really pretty silly, right? So all these labels and words we created in this industry, I don't think is helpful at all. So I don't want to use them anymore.
So are you a responsible investor, John? Are you an irresponsible?
Yes, I'm a fully responsible.
Responsible. Good.
So Neuberger Berman, we're a private employee-owned asset manager headquarters here in New York, and we manage listed equities, fixed income, and also active in private markets, and have just over 300 billion in client assets under management. We've been on a long journey. We've used, I think, every one of those terms going back to the to 1989 when we set up our socially responsive investing team. Now we talk about sustainability and impact, and I think that just reflects really the sophistication of the way in which investors can measure and value the impact of sustainability characteristics on the long-term performance and resilience of businesses. And so what I'd like to do in the next few minutes is to talk a bit about how do we do that in practice and what difference does that make to the portfolios that we build on behalf of clients. And I'll focus my comments primarily on the public markets, as Bob suggested. So we have a system that we've put in place where every single stock that we cover has an ESG analysis attached to it. So we've done a proprietary process, we've built that up. And so you can start by looking at what's material, right? And the work of the Sustainability Accounting Standards Board, which many people will be familiar with, is a really helpful starting point. So if we're looking at the chemical sector, we're going to look at things like worker health and safety, the operational efficiency of the plants through water use, through the emissions, both greenhouse gas and air pollution. We're also going to look at the relationship with the local community, and we're going to look at product innovation, right? Are the companies involved actually making chemical products, whether it's plastics that have got more recycled content in them, or that have lower risk of involving REACH chemicals that are more highly regulated in European markets and in California. So those are things that we want to be able to assess. But the problem is that many of those individual issues are not disclosed by companies, right? So for the corporates in the space, I'm sure if you work at a chemicals company, you have data on all of those things internally, and you may be disclosing some of that to the market, but in other cases, you may not. So the value that we think we bring in our ESG analysis is to try and dig into that and find proxies and use big data and advanced analytics and talk to companies and talk to NGOs and to talk to academics to try and get a view of how companies are performing on those issues in a forwards-looking manner. And we've done some analysis of the performance of all, not just our own, but all active ESG equity strategies over the last 20 years and compared them to passive strategies that will take an off-the-shelf rating. And you won't be surprised to hear that the active strategies outperform systematically on a 5, 10, and 20-year basis because they have people who are talking to companies, digging into this, and understanding the underlying data that's there. So the question then is, why wouldn't you use this in all of your investment strategies, right? Why would you want to put a sustainable label on that analysis rather than putting it in everything you do? And that's our view, right? So we don't label those funds sustainable funds. We just say this is good investing, and therefore it's part of our evaluation for every equity and credit research analyst at the end of the year, and it's part of the performance analysis for every portfolio manager at the end of the year. Now, I'm not going to pretend that every single one of them is doing it at the level of sophistication that I would like, but that's where the culture change piece comes in and is part of the innovation that we have to do on an ongoing basis. Today, 60% of the assets that we manage systematically consider those factors in buy, sell, and valuation decisions. So every single security is adjusted in terms of price targets or in terms of weight in the portfolio qualitatively and quantitatively by that analysis, and that's up from about 30% 3 years ago. So we have a very high bar for what we consider to be proper ESG integration, and it's one that we're continuing to push forwards and expect to be up towards 100% in the next 2 years. So let me say a few more words about the types of analytics that we're running and the way in which that has helped us. And I want to talk about climate change specifically because I think it's one that all of us, I'm sure, are thinking about. So one of the things we built last year was an in-house climate value at risk scenario modeling capability, which we're going to be publicly announcing more details on in the next few days. And one of the things that we wanted to do was to truly try and understand how might changes in weather patterns actually affect the cash flows of companies. So we looked at many of the big data sets that we have. For example, credit card data. We isolated the effect of hurricanes on same-store sales in regions of the United States that had actually had hurricanes historically to see what the impact on retail spending patterns was. We also have a strategy that uses, we have 3 internal climate scientists who basically build weather models who look at the impact on the insurance sector. So we looked at who has property and casualty insurance exposure that will be affected by changes in climate change. And sometimes the results are not what you might want to hear. It turns out Home Depot does better from hurricanes, right? They close the stores for a couple of days, but then actually they make more money as a result of the bounce back in the periods afterwards. So when you start looking at the location of different competitors in the space, right, you need to think about these things. So the question for us is, there are so many of these analytical deep dives that we can do. Which of them are going to help us make better investment decisions? And what maybe will we choose to spend less time focusing on of all of the things our analysts could be looking at, or that we can automate, or that's more simple, or that's priced in? And how can we continue to be at the forefront of the analytic capability that's out there in the marketplace? And so that's what we're trying to do. So some of the work that the Center's done on what customer buying patterns look like in the consumer sector, right? Those are the sorts of insights that are really helpful as we try and look at the positioning of different companies. Just take what's happened with the mining sector recently. We identified the tailing risk as one of the most material issues in differentiating between mining companies. It's very hard at the moment to quantitatively assess that risk in a systematic manner. So we sent our analysts over the last year out into the field to talk to engineers and to talk to companies about how they were managing tailing risk. I can't say we've got everything right there, but we were underweight Vale as a result. Now, I think that sort of deep work is important. It delivers a return to us and for our clients, but also by having dialogue with the companies involved, we're highlighting that we are thinking about these topics, and we expect better disclosure, and we expect better management of those risks and opportunities. So where does this go in the future? I think we're going to get radical transparency. I think that's where we're going, right? I think the idea that you're putting in some data that's 18 months out of date, that's in a CSR report, and that's what investors are going to be making decisions on is going away. I think people are moving further forward. They're trying to find other ways of getting at it, and they're using proxies. So the question for companies is, do you want to be part of that movement? Do you want to own your own narrative about why you're an innovator and a leader? Or do you want to basically be penalized by a set of metrics that you may not even have any control over or know that people are using? So we are very clear. We say, tell us about what you're doing, lay out the long-term strategy, tell us how it's linked to incentives and compensation, and how you're allocating capital behind it, because that ultimately helps you deliver better returns and helps us deliver for our clients as well.
Great. Thank you. So, Elizabeth.
I feel like everything's been said already.
Actually, it's interesting, right?
So,
because as we were talking about over coffee and lunch, I mean, private equity is huge, right?
Yeah.
And it's a different world, and you don't have all the kind of arguments about litigation and things that people whine about in disclosure. So in a lot of ways, I look at private equity as like sort of a perfect test bed for putting these things into practice. You own the companies, you know, you can engage deeply, you can get the data you want. So it'd be great to hear what you're doing.
Yeah, sure.
KKR.
I'll definitely talk about that angle. And I'm glad you all sort of addressed the terminology issue up front, because I think it's so critical to get that right and that everybody know exactly what we're talking about when we're talking about it. And if anybody's sort of new to that, to this space and trying to understand the terminology, UBS actually published a really good article around impact investing prior to the World Economic Forum this year. And one of the figures in their report, figure 6 for anybody who's taking notes, is lists all the terminology and what do people mean when they say it and how much they overlap, and I think is a really good way of sort of looking at this problem and trying to drive toward a solution, which I think we need. Anyway, so I work for KKR. I've been at KKR since 2009. This is my 10-year anniversary. Prior to that, I was with the Environmental Defense Fund, an environmental nonprofit organization. And I joined KKR to manage our responsible investment efforts, sustainable investing efforts, ESG efforts. I made up my own title, by the way, and when there was a lot of drama over in my head. It was all in my head. A lot of drama in my head about what I should call myself, because I understood that whatever term I used, people would have an understanding of what that meant from their perspective. And so, anyways, if anybody wants to talk about why I chose this, I can bore you with that later. But I've been at KKR since 2009, entirely focused on thinking about how do we integrate the consideration of E, S, and G issues in our investment process. And when I joined in 2009, we were basically all private equity. Most of our assets under management were private equity. We're now much more diverse than that. It's as I was telling Bob over lunch, one of my areas of focus is understanding what do we take from the private equity space and apply across our other asset classes. But the private equity model is a really interesting one, and one that I think most people in the world don't really get or know about. It's been private and sort of under the radar. And the model is that we are investing funds on behalf of asset owners, who their beneficiaries are retirees and pensioners. So we've estimated that about 50 million people globally sort of benefit through retirement accounts and pension funds due to the work we do in our investing. But we will invest in a company, oftentimes take a majority position in that company, and remain invested in it for a period of an average of 5 to 8 years. Have active governance during that time period, where we often or almost always, I guess, sit on the board, have 1 or 2 board seats, and have deep engagement on an operational level as well with the company over time. And so if you think about it, that is a really interesting and powerful model to think about ESG issues. And oftentimes we're investing in companies that may be relatively immature or at a point where they're expanding their business in a meaningful way, and it's a really great time to get in and think about ESG-related issues. Unlike some of the companies that have been reporting publicly for many years, they're also, sometimes nobody's asked them these questions before, right? And when we come in there, they may not have the data that they need or the systems and processes that they have in place. And so we have the ability to go in there and work with them over time. The other thing I should note that I forgot to mention up front, I'm also a member of the Sustainability Accounting Standards Board. So for those of you who don't know, there's a two-board structure. I'm on the group that actually evaluates the due process of developing the standards and make sure that the standards that come out have followed the due process that SASB has identified. So we see all the standards. We read thousands of pages in the codification process. And I've personally been involved with SASB since 2011 when they were first starting it, because while SASB was focused on publicly traded company disclosure, we recognize that even from a private equity perspective, the tools and sort of list of issues that were coming out of SASB would be very relevant and helpful in the private equity perspective as well, in terms of helping us focus on what was material and not focus on things that were immaterial. So even for those companies who are in the room, even if you aren't publicly traded, if you're a private company, it's still relevant to think about materiality in the same way for your other investors. I'll stop there, except for I'll also add that approximately half of my time now is focused on KKR's global impact investing strategy, which we announced at the end of last year, where we've actually developed a dedicated pool of capital for intentionally investing in companies that help provide solutions to critical challenges around the world. So I'm happy to answer questions about that as well.
Thanks. Let me just add one data point. We couldn't confirm this at lunch, and so Elizabeth is a more responsible person than I am. I'm going to give you some numbers that could be wrong, but I'm going to give them to you anyway. They're close enough. Why I think private equity is important. I mean, it's an asset class that's grown a lot. You know, the LPs want more and more so they can get the returns they need. Jonathan, you can check me on the numbers because you're involved in this. 6,000 private equity firms around the world, I hear.
Just say yes.
Yes, yes.
Yeah, so there's about 5.
Yeah.
The Oxford grad says there's 5,000 to 6,000 private equity firms around the world. He's got degrees from Harvard Business School and Harvard Kennedy School. He must be right. And like so-called dry powder, money still waiting on the sidelines to be invested of $2 to $3 trillion. So the private equity asset class is I think, as I said, it's just a great opportunity for the kind of things that we're talking about.
Yeah, I mean, KKR alone, I think I just read we have $56 billion of dry powder waiting to invest. And, you know, if you think we were talking about this at lunch as well in terms of the scale of just our portfolio where we have, don't quote me on this number, but it's over 100 private equity portfolio companies. And then a number of other companies in other asset classes. We just did a survey of a large section of our portfolio, and the employee base there is 735 employees compared to KKR's own 1,300. You know, our ability to reach these companies at scale is really another part of the model that is really interesting.
So you're 56 billion?
56 dry powder, 190
Dry powder.
is my
So
understanding.
you've got
100.
almost as much dry powder as you've got assets. You need to do a better job.
We have a substantial balance sheet too, which helps. Yeah.
Grow those assets. Bo?
Sure. So Inherent Group is a fairly young organization. We were founded a handful of years ago, and we have 13 people. Our business model sits at the intersection of value investing and sustainability. Really, we're a value investment firm that uses sustainability throughout our process. And you know, what do I mean by that? Well, sustainability, or ESG, for us it's a sourcing tool. It helps us identify thematic investments, businesses whose model is aligned with some social or environmental megatrend. It's an underwriting tool, which is to say, when we engage in the analysis of a company and we call up IR and we ask all the usual questions, we then also ask another series of questions around sustainability, targeted at what we think are the 1 or 2 material issues that we think will drive valuation. And inevitably, that person will say, that's a great question. I haven't gotten that one before. Let me get back to you. And then we'll get follow-up calls with a myriad other people. It could be sustainability professionals, could be the CFO, could be HR. Inevitably, it leads to a richer, much more broad dialogue and understanding of both the business that we're investigating and the culture of that business, which we've heard a lot about today is sort of supremely important. And then ESG, or sustainability, we use as an engagement tool. For those businesses that we invest in, for at least a subset of them, we will engage in a very material way on the, again, 1 or 2 really material issues that we think will drive value for a business. So that could be something that's relatively short-term in nature. So, for example, we engaged with a company that makes a compound called carbon black, and the nature of our engagement there was to ask them to hurry up and get on with settling with the EPA with respect to some violations that were outstanding. They did that, and a very significant valuation gap closed with their key competitor. That valuation gap was worth $400 million on a $2 billion business, so it was really very significant. More often, though, the nature of our engagement is around long-term issues. You know, the ESG has sort of been alluded to, or the application of ESG and implementation of sustainability and integration it's a long-term effort that ultimately pays off in what was described earlier as sort of a submerged value. Dan Aronson and I really like that language. That's what we're after. We're after uncovering that submerged value and shining a light on that, working with management to help them identify and bring that to fruition. So an example there would be a business that's engaged in protein rendering, where we are invested with them, and they are part of the circular economy, taking animal waste and essentially turning that into valuable commodities. That business also happens to sell its waste fats into a renewable diesel operation. But there, they sort of had a vague notion that they're supposed to be engaged in sustainability, broadly defined, but they didn't really know what that meant for them. They didn't really know how to communicate that to investors or their other stakeholders. And one of the biggest challenges facing that business is that they don't have a deep management bench, because nobody really wants to work in the rendering business. Certainly nobody coming out of the business school here probably. So we said to them, look, you've got to improve your communications. You have to engage in better branding. You have to engage in better recruitment. You have to explain to people why your business is so important to the circular economy and the things that you are doing operationally to integrate sustainability. And so for us, we're just starting with getting them to identify KPIs with respect to health and safety, for example. And then from there, it's going to lead into designing investor-related communications, recruiting-related communications, with the goal that ultimately we create a more durable business because they have lower turnover and better capability to source human talent. And our business, though, I agree with basically everything that's been set up here. We have seen, as I mentioned, sort of near-term valuation improvement in the case of that carbon black company. We're engaged in long-term value creation. We've also seen loss avoidance. We were not involved in Pacific Gas and Electric leading up to recently, and the clear reason for that was all the work that our team did around wildfire risk specifically, and also the safety culture that did not exist at Pacific Gas and Electric for many, many years. So in our short lifespan of just a couple of years, we've seen short-term value creation, we've seen loss avoidance, we've seen real engagement with companies. And one of the most surprising things about the whole experience has been the extent to which companies large and small swing open their doors and say, come on in, because we need help with this. We don't know how to communicate with our investors, and everyone's asking us. So for a little business like us, we actually swing well above our weight because we're bringing something to the table when we talk to our target companies.
So a quick question before we go to Rena. I kind of think of ESG integration, sustainable investing, long-termism as kind of two sides of the same coin, right, as you were talking about, Herman. And you said it's like a full business cycle. I mean, your holding periods are 5 to 8 years. Like, what's long-term for you? What's long-term? 5 years, 10 years, 20?
Well, for us, long-term would be something we underwrite to 5 years.
Okay.
Now, we would like to own a business that's going to compound for many, many years beyond that. Our largest investor is our founding family, and so we have genuinely long-term capital, and our other partners are similarly minded. But our underwriting period is 5 years because we think that's the period of time that we can reasonably analyze.
Good, thanks. We're best friends, right?
Yes,
Rena,
we are.
We're best friends. Good.
Yeah.
Just want to make
Let's see.
sure.
Let's
I want
see.
that
Yeah.
publicly disclosed. It's on tape. We're best friends. Good.
So, well, besides having a lot of money at UBS, we actually have been working with the World Economic Forum in the last 3 years to push the topic of sustainable investing really hard. Not only about the opportunities that we see in terms of investing, but actually also creating a little bit of urgency for other financial services and to be part of this narrative. 2 years ago, UBS made a public commitment at the WEF where we said we were going to mobilize $5 billion US dollars from our clients towards impact investing. Easy said, hard to implement. And the reason why, as Elizabeth said, around the dry powder is that, there are not many deals out there that we can classify as impact investing. So we have been working with the industry specific, with the private equity funds actually to identify strategies that align with our definition. And it has been said that definition is an issue, so that's what we have been also spending a lot of time in task forces, but also with institutions, creating frameworks, and we're pushing now for a more global standard of what sustainable investing is. And I will tell you how UBS define it. Basically, we have 3 pillars. The one is the exclusion, which is the value base, which much of the pension funds are using. And it used to be like what we call social responsible investors now. And that actually moved to a more responsible lens, which it means saying that, okay, if we are excluding from this portfolio, what else and how can we have impact? Then the ESG was integrated into the definition. And then ESG was only actually to look into metrics and environmental, social, and governance and try to screen companies into best in class, worst in class, and trying to decide where I want to allocate my money. So what we did this year actually is say, okay, this is one approach, but we want to have most of our assets to have an ESG lens, which means doesn't have to be a fund that is a thematic fund, investing in water, investing in climate, but actually that all assets should be screened with an ESG lens. So we have actually under ESG integration 2 strategies. One is on the research side, which means every single analyst, at least in the asset management right now, has been trained how to integrate non-financial data into their models. So meaning that asset management by the end of this year is going to be probably the first one where every single dollar that is invested had already an ESG integration. And the second part is what we say the thematic part. So we want to be allocating money more to themes, to water, to climate, then we have a different strategy on that. And that's where all of the ESG researchers also come with new technology and help us actually to identify that. And the third pillar is on impact investing, which we started actually more focusing on the private side because we thought, okay, if we really want to have an impact in companies, as Elizabeth said, private equity is the best actually asset class because you can go and own the companies and work with them. What we have actually introduced since last year is the engagement now in public equity. And that's the way that we define impact investing in public equities. We say we don't just want to go into companies and tell them what they're doing wrong, but actually we want to have a dialogue and to make them better. So, and that's actually a strategy that we are focusing this year with partners, but also with our asset management arm and saying, how can we use the amount of capital that we have to help these companies understand that this data is not just about saving trees and, and reducing your carbon footprint, but actually is key for your business and how to generate more revenue. So something around what is a sustainable performance for a company. So if we see it more with a CFO perspective, and I will say we try to educate now companies with our investment bank and not only how investors are integrating this kind of data into the models, but actually how can you integrate sustainability as a part of your strategy, not only on the organizational level, internal processes, for your customer and in your financials. So it shouldn't be that difficult. It's just we have to change the terminology. We cannot call it ESG, we cannot call it sustainability. I like to call it more sustainable performance. If you really want to lead and you really want to stay, actually this is the way to go. So I think for us at UBS, as I said, I mean, I wear different hats because I work with all the business divisions, but also for us as a corporation, it was important, okay, if we have the ambition to become the leader for our private clients and for our institutional clients, we as a corporation also have to look how we're doing business. So we're very much focused on dividing this strategy and how we operate. So means all of the buildings that we're at around the world have to be LEED certified, and we have to have some sort of sustainability strategy. How we actually work with our clients, which is the one that I focus more on, that is creating products and services and educating our clients around why sustainable investing is important, but also there is no reason to sacrifice performance. So we have actually launched in our wealth management platform 100% sustainable portfolio, these cross asset classes that actually give you the same return as a traditional portfolio or even better. So, and it has been proved now after this whole volatility months that actually our sustainable performance are very robust. So, and I think educating clients around this myth that you're gonna lose money because you are, having an ESG lens is a big part that we're doing. And the last part is actually, how we work with the communities and the employees. And as a corporation, I think, we always think, and I think it was on the lunch on the panel, that, questions around employee engagement and retention and so on. This is also important, not only because you need the talent, but also because we as an investors are looking into these metrics, right? So the better you manage your company, the more money that's gonna be available for you. So I think for us as a corporation, but as an investor, we went with a strategy that is a little bit holistic, but it's also an umbrella that is driven by our group CEO, and is very embedded into the business divisions. The reason, because we want to do the right thing, but also because it's the right thing for our business. So most of our ultra high net worth individual clients actually had told us that 80% of them actually want to invest on sustainable investing products. 70% of the assets in the United States are going to be managed by female clients by 2020. And our female clients have told us actually that they want to invest on sustainable and investing and impact products. So there is an opportunity for us actually to win and retain businesses. And the third part is the millennials, right? So the transfer of wealth is happening, and about, I think, 20 to 30 trillions are going to be transferred in the next 7 years. So we better have a robust strategy also how we're going to offer services and products for that segment. So I think that is not only from I think with the conscious of doing good, but also it's good for our business, right? And with the World Economic Forum, as I said, we have been doing a lot of this work, but also with the company CEO at Davos, we have been holding, as a young global leader of the forum, having these conversations, closed doors with CEOs, actually, to make them understand this is not only, the tree huggers that are telling you need to be better. This is actually because it's important for your businesses. And I think for the corporations that are here today, it is important that the message that you take, as it was said, on your narrative, but not only on it because you want to put, good stories out there, on it because it's important for your business.
So let me make an observation we can open up to the audience. It's interesting. Despite a lot of data, things that you guys are all doing that's actually it's good for financial performance, there still is some mythology out there about it. Maybe it's a language thing that goes back to the old SRI days. But that's changing. 25% of assets in the U.S. CIV says some kind of sustainable investing. There's different strategies. It's 50% in Europe. It's about 33% in Canada. It's much lower in Asia. But you can kind of see the trend. The other trend, maybe just a few quick comments, we'll open it up. So you've all talked about engagement, right? And if I think about the sweep of history, Tansi, back when you were a girl and I was still an old man, what it looks like to me is that for years the corporate community was a little bit ahead of the investment community, actually quite a bit ahead. GRI was founded in 1997, sustainability reporting was coming along. There's a lot of greenwashing, and it was kind of by the CSR team, which was kind of second-class citizens and all that. And the investors just didn't care, right? They didn't care. And I think it's flipped in the past 2, 3, 4 years. I think it's flipped. And you've got examples from everybody on the panel that are saying, we know this is important for returns. We want to engage with companies. There's things we can do to make them better. Just a few quick comments, and we'll open it up. If you're going to give advice to companies as to how to engage with you as investors as effectively as possible, what would it be? What are the components? Who do you want to be talking to? Just real quick from everybody, and we'll open it up.
Well, I think what's important is, especially on the investor relation call, it's only normally focused on the earnings and financial data. And so the rest is quite often still out of scope. For two reasons: the portfolio manager is still feeling more familiar, but with tapping into the space, which is a little bit new. But talking about, what are factors? If you look at from a company perspective, you are operating in a certain environment, and you have a sort of a footprint in society, and the footprint you have in society can create, will have impact on your P&L. And so it can be positive, but it can also be negative. And we want to know as investors an understanding from management and a realization that you are aware, first of all, that you have a footprint, that it's relevant, and having a dialogue about, okay, where do we see sort of from a risk perspective, what could potentially impact my P&L, or where do I see the opportunity set? So the discussion need to change from just financial accounting stuff to sustainability.
So why don't we go ahead and open, and other people can kind of chime in as we go. We've got 15 minutes left. It's a great panel, so I want to give you all the benefit. Ask them whatever questions you want. This gentleman with the glasses who's standing up.
Hey, yeah, Alexander Golden. I'm an alumnus, but also I work with families across the country on growth equity and impact investing. I'm curious, so in the public capital markets, how do you define like the G part of ESG? Are you actually going in and replacing board members? Are you looking at the compensation committee? How focused on governance are you in terms of analyzing factors of material to the company's long-term success?
So I'm happy to answer that. So we have run contested proxies at companies to basically argue that there should be different board members. We've run and won those in a couple of cases in the last 2 years. We've also been involved, not at getting to that stage, but in very public dialogue with companies where there have been environmental or social triggers that have caused a valuation issue, but that there's an underlying governance failure, right, which is then revealed. So a good example is a company called Nuance Communications, a Boston-based tech company who basically does speech-to-voice technology, think Siri and all those sort of things, and they do a lot in the healthcare space. They had a cybersecurity breach, and private data was disclosed, and the company told us that it was largely because Windows hadn't been updated, and we felt that was not a sufficient response to something as important as that. And we looked at the board, and there wasn't the right expertise there. We thought the compensation structure was not aligned properly. So we actually worked with the company on changes to the CEO, the comp structure, and the board. So I think governance is the thing that people will always say is the easiest and the thing they've been doing forever. But I actually think these things go very closely hand in hand, and that it's not good enough to engage in the spirit of buying really great companies and telling the CEO how good they are. You also need to be willing to buy companies that maybe also need engagement to improve, and governance is often a lever.
Maybe Bo, do you want to weigh in on this?
Sure.
Too?
Yeah, I think governance is hugely important. It's one of the first things we look at in every situation. And there's one company, managed care organization, that we were invested in and we're really excited about because of the demographic tailwinds behind it and so on and so forth. And problem was, it was a founder-led company where they had not updated their executive compensation plans to be reflective of the world today. And so what does that mean? In managed care, you win contracts, say, for Medicaid or Medicare programs on the quality of care that you deliver and the efficiency with which you do it. And there's a lot of statistics around that. Now, this company's key competitors had very clearly embedded into their executive comp plans outcome metrics. In fact, in WellCare's example, well over half of the most senior leadership's compensation in the long-term plan comes from achieving certain metrics with respect to healthcare outcomes. In the case of the company we were looking at, it just wasn't there. It was just shareholder returns, essentially. It wasn't even return on invested capital. It was just shareholder returns and some vague notion of sort of personal contribution to the enterprise. So we started engaging with them, trying to get them to change that, because the reality is people respond to incentives. Incentives are incredibly powerful. It's kind of an obvious statement, but they really, really do. And if you're engaged in trying to win RFPs on a state-by-state basis, and you slip up in state X because you aren't either efficient or worse, you have bad outcomes, you actually wind up hurting people, as happened with this company in the state of Texas. That's a real enterprise problem and an existential threat potentially, especially given everything that's going on with respect to changing healthcare. So ultimately with this company, we were not successful in getting what we wanted, and we had a whole conversation around elevating that to eventually a proxy process. We decided to bow down for now because we don't think that the governance structure is there to sort of enable the transformation we want to see.
Any other questions?
Sure.
probably good for John, because you probably have the biggest public portfolio. How do you handle a situation like Boeing, you know?
So we do have a position in Boeing, and it's been a long-standing position with a very constructive dialogue with management, and we are talking to them about the tragedies that have happened, and clearly lessons need to be learned and appropriate steps need to be taken. But it's not something that's going to be a short-term fix, right? I think this is a great example because we're actually, you mentioned it, we're the global lead for the Climate Action 100 Plus initiative, working with Boeing on their climate change impact. And that's a multi-year effort. And so it's something we're going to continue to do. It's something that we think is really important. But obviously you have to put that in the context, right, of what's the most pressing financial and, in this case, a social issue too, right, that as an investor we need to be focused on today, because the stock's, I think, down 5% now, because of what's happened. So that, you have to both be able to engage on long-term sustainability topics while at the same time making sure you're getting the transparency to inform whether we should be buying into the stock at this point, or whether there's more that we should be uncovering.
So maybe somebody from this side, the lady in the back, near the pillar.
Thank you. So you mentioned long-term and sustainability. Well, by way of introduction, my name is Matt. I just graduated from Stern in May, so awesome to meet Matt. Shout out to all the organizers. Thank you for putting this together. So in terms of sustainability and long-termism, one thing I often wonder is you all come from very reputable firms and pension funds, and we see often the conversation happening around ESG and sustainable investing, but at the same time, we might have conversations around it, whereas the same firm, foundation, endowment may also be investing in very contradictory institutions. So the weapon and industrial complex, the prison industrial complex, many, many more, the list goes on. When we talk about long-termism and integrating ESG into various parts of a firm or a pension fund investing strategy or an endowment investing strategy, do you see that these criteria are going to be incorporated into every part of a firm or whatever that entity we're talking about is, or do you continue to see that challenge staying over the upcoming 5 to 10 years, where we're still talking about human rights on one side of the firm, or again whatever entity, but at the same time owning, let's say, prisons wholly or entire portions of weapon companies?
Yeah, I can take that. Absolutely right. So I think, and that goes back to my comment, as a corporation, you also have, if you want to be the leader in the space, you also have to look at home. What is it that you are doing? I think our latest data is going to be probably reported today or Friday, so I cannot release, but we have been working a lot on that, looking into our pension fund, but all the assets that we hold as a UBS, and having a specific strategy how to manage those and reduce exposure from a climate change perspective, but also from all of the controversies. So we follow a list, and then we decide which year what we're going to focus on, but specific on climate, we have been actually doing in the last 2 years and reducing our risk exposure to climate. Yeah.
Other questions? Yes, sir.
Phil Clausen again. So you've talked about, and we've seen good research on the performance benefit to companies that you're investing in. Can you say anything about performance benefit to your own companies of applying these lenses and thinking in this way?
So I'm not sure what you mean. You mean their company is the unit of analysis as opposed to their portfolio?
Exactly. So are you seeing new markets open up? Are you seeing better risk profiles? Are you seeing better performance across the metrics that your leadership is evaluating against?
I'll comment very briefly, and we're a very young organization, as I mentioned, but one area where we're seeing a real advantage is our ability to attract the best people. New fund management, people talk about how hard it is to raise financial capital. They talk less about how hard it is to attract terrific human capital. And we are getting candidates that we would not get if we were not engaged in the business we're engaged in.
Do you think, you've been doing this for a long time, do you think this is an advantage? Has this been a competitive advantage in fundraising?
Yeah, well,
for you?
actually, I'll make 2 points. One is we talked about all the dry powder that's being, we want to find investment opportunities. I think I don't have numbers for you, but I have anecdotes that support that companies that we want to invest in want to know that their major investor and their board members are responsible partners. And so that has actually, our being able to prove that we are responsible partners and that our values align with theirs has made a difference in I have one at the top of my mind at the moment, but in more than one case for sure. The other thing is absolutely from a fundraising perspective, most of us on this panel have experience talking to investors who are continuously asking additional questions, and the bar keeps rising and changing and moving. And absolutely, we cannot have we can't have a fund these days without being able to articulate what we're doing and why it's important, and that we're very thoughtful about it. And when I started in 2009, actually 2010, we started tracking the number of questionnaires we got from standalone ESG-focused questionnaires from fund investors. These don't include questionnaires with questions integrated in them. Anyways, we went from 1 in 2010 to, I think we were at 30 or so in 2018. And that may not seem like a lot, but actually it is a lot, and the growth is pretty significant, and that doesn't include all the other conversations we're getting, so absolutely key to that conversation.
So you're a listed company.
I was going to say our sustainability report, because we are listed, but also because we have business in Germany, is over 200 pages, right? So I'm going to put my professor hat right now. So if you want to evaluate a company, there are over 400 KPIs that actually you can use to look into environmental, social, and governance information. So most of the providers will give you a snapshot, but if you really want to work with the raw data, that is not for all of the companies, for more of the public traded companies, there is a lot of data out there that you are not seeing. So there is a lot how you can incorporate this. But yeah, I mean, we have seen it as well. So as a corporation, we also engage with our investors, and they also ask questions around what UBS is doing and all of these topics. Yeah.
So I think we've got time for maybe 1 or 2 more questions. Lady right there with the Mac.
So along with those questions, what if those companies under 400 KPIs or not obliged to disclose their ESG score or the number? What if they manipulate their numbers, and then you can find discrepancy about the ESG, that reports, and then your sustainability practice? How would you validate those numbers?
You mean from the ESG researchers or?
From the investor perspectives, because you really want to know about they actually change their corporate behaviors in a sustainable way, but they're really good at tweaking the numbers, and they get the higher grade with the ESG scores from the Sustainalytics. And so how would you validate their?
Yeah.
So could you repeat the question for the audience?
Yeah, basically it's how you as an investor can evaluate if companies are not tricking you for every year when they're reporting, right? So, because you can get smarter, right? The way that I mean, if we got a low score in social, I mean, how can we improve that, Well, basically each of the ESG researcher companies have a different methodology, so you cannot compare, if you're using MSCI and you're using Sustainalytics to compare different sectors, so you really have to stick with one, because their methodology doesn't change very often. And one of the things that we have figured out is not being smart how to communicate with investors, but basically understanding what is the investor ask. Maybe something that we haven't disclosed, but we have the data, but we decided not to include it in the report. It doesn't mean that we're tricking them, but it's just making that information available. And then second is identifying also what is material. And the way we do it, we actually have a kind of a survey that we send to our stakeholders. So we ask our investors, we ask our clients, our employees, what is material from them from an ESG perspective. And we publish our materiality metrics on our website. So everyone can see, for every second year we do the survey and we check, are we on track? And those most are the information that we publish. But there is another issue with the data. Even if we disclose, sometimes the methodologies don't include the information that you actually reported. And sometimes there are mistakes in the reports from MSCI and Sustainalytics. It took us about 6 months actually to correct 3 key data points with them. 6 months. So if you're an institutional investor and running a portfolio and screening them based on these factors, actors, you are getting, the wrong impression, from if it was environmental, social, or governance. So I always said it's good to have two sources, but I always say do your own diligence, and I know it's painful for corporation because the amount of the questionnaires that you get, but it's better actually to be providing that information to your investors in a structured manner. Yeah.
So we've got 1 minute left. I'm going to let Herman wrap it up.
Just to build on this, and also what you said, Jonathan, about transparency, which will improve, and the importance of data. And I think what we're doing currently, research on using AI and big data, machine learning, and all those kind of techniques. And we link that to our ESG framework and research. And then we link it to the SDGs, the Sustainable Development Goals. So, and what we will hope to learn from this research is sort of understanding the SDG footprint from a company based on what we measure with AI, and then compare that also what they're saying in their CSR reports. And is there a discrepancy? That's going to be a very interesting topic for discussion. Not saying that they're wrong or something, but at least you have something to talk about. And I think my prediction is that AI will be a huge driver in transparency in this space, and will help both investors and companies to actually improve their businesses and actually improve their performance.
So just last comment from me on this AI big data. It's interesting. I've seen about 3 or 4 these little AI big data companies pop up. They're all by sort of under 30-somethings that understand the stuff that, to be honest, I never will. What they can do is really quite interesting. This group that Herman is talking about, they can come up with the footprint. They, go through all these different data sources. They can read 60 different languages. So the message to companies, it's what, Rena was saying, you can either follow Jonathan's advice and you can report and understand what your investors want to know and basically control the narrative, or it's going to be controlled for you. MSCI will do its thing, and Sustainalytics will do its thing, and AI big data companies are going to do their thing. So there's lots of sources of data for investors, and they're getting increasingly sophisticated about how to use it. And so I think it's a big opportunity for companies, because investors until recently haven't cared. They care now, but I think companies need to catch up with the investment community. With that, I will wrap it up. Thank my panel very much.